On the evidence of broad indices, markets were reasonably calm in the third quarter. The MSCI World Index of Developed Markets returned 5%, continuing its outperformance of emerging markets, which were down 1%, while bond markets were mixed, with most government markets across the developed world down by around 1%, whereas credit outperformed, with high-yield bonds returning over 2% and emerging market debt 1.5%. However, these broad indices hid a number of undercurrents which reveal a wide divergence of returns and some developments to worry investors. Returns in equities were again dominated by the US, up over 7% in the quarter, while the rest of the world was flat. The US economy has been turbocharged by Trump's tax cuts, deregulation, and infrastructure spending, leading to a 25% rise in corporate earnings so far this year, whereas the recovery in Europe has stuttered, and the fragility of the Eurozone is again exposed by Italian politics and the new government's loose fiscal spending plans. Emerging markets have suffered as the period of ultra-loose monetary policy draws to an end, and interest rates in the US rise. A combination of rising rates, reduced liquidity, and a strong dollar has proved toxic for the most vulnerable emerging markets, with currencies and bond markets collapsing in Argentina and Turkey. The deteriorating trade war between the US and China has already impacted on sentiment across Asia and has begun to affect China's growth rate. Asian markets weakened in the quarter, and China's market fell further into bear market territory from its January peak. The UK remained under a Brexit cloud of uncertainty. The economy actually proved to be sufficiently resilient for the Bank of England to raise rates by a further 0.25% in August, but UK equities fell marginally over the quarter and have now underperformed the rest of the world by some 30% since the referendum in 2016. Within equities, growth stocks materially outperformed other style factors, especially value, continuing a trend that's persisted for most of the post-crisis period and leading to stretched valuations across many growth stocks. Other important trends that continued into the third quarter were a further rise in the oil price, taking its price up by 24% this year, triple its low point of early 2016, and dollar strength, with nearly all currencies falling against the dollar, the only real exceptions being the Mexican peso and the Canadian dollar, which reacted positively to the announcement of a new US, Canada and Mexico trade agreement to replace NAFTA. Amidst this array of potentially disruptive factors, the most important to the continuation of this long economic and market cycle are the actions of the Federal Reserve and the outcome of the US-China trade war. Both of these are sufficiently important to have a substantial impact globally on growth rates and with the repricing of risk-free assets on financial markets around the world. Other immediate concerns, including Brexit and Italy, they're more localized in impact, and in these cases, they're likely to be solved by the classics that the EU muddle through. The Fed continued on its monetary tightening path, pushing rates up by another 0.25% to 2.25%, and from the 1st of October, increasing the pace of liquidity withdrawal to $50 billion a month. Ample evidence of a strong economy and further falls in unemployment suggest that the Fed will continue with its projected tightening program, with a further rate rise to come in December, followed by 3, possibly 4 in 2019. With the ECB gradually withdrawing monetary stimulus and planning to end its asset purchase program at year end, the world faces the first liquidity withdrawal from the major central banks since the financial crisis, accompanied by a return of short-term interest rates to around or even above the Fed's neutral long-term rate of 3%. Investors will rightly be worrying in the months ahead whether the Fed can engineer a soft landing or whether a recession will be the inevitable result of its policy shift. Every Fed tightening cycle exposes vulnerabilities. This time around, there are clear pointers to where the problems lie: developing countries. Those with too much debt, particularly shorter-term dollar debt, and running fiscal and current account deficits, they're already suffering. But the risks of contagion are limited. Argentina and Turkey fit the classic bill of big economic imbalances with current account and fiscal deficits and an inability to fund themselves domestically, so a heavy reliance on offshore borrowing. Most of their problems are self-inflicted. Other emerging countries face problems, but these are more in the nature of sort of normal cyclical patterns than systemic structural issues. Most emerging countries, especially in Asia post the late 1990s crisis there, have reformed and restructured so that they're much stronger financially today and less vulnerable during a tightening cycle. Not to say there'll be no further bouts of nervousness as the cycle progresses, but the risks of meaningful contagion seem limited. The second big factor, the fear of an all-out trade war between the world's two biggest economies, the US and China, escalated during the quarter. The US implemented higher tariffs on a range of goods from China, with China immediately retaliating, and evidence is emerging that the tariffs are beginning to have some impact on exports, confidence, and hence growth rates in China. The authorities there reacted to the slowdown by easing monetary policy with the fourth reduction in reserve requirements this year, thereby injecting additional liquidity into the economy and by boosting infrastructure investment. Interbank rates in China fell by 1.25% in the third quarter, down now to 2.75%. China has the financial strength to navigate a more difficult growth environment, and unlike many emerging markets, is not reliant on foreign lenders. But if the trade war deepens, a serious risk given the sort of intransigence of the two leaders, the impact on global growth could become meaningful. So as we enter the final quarter of the year, uncertainties abound and the Goldilocks environment of 2017 is under threat. Encouragingly, the policy tightening so far has had a relatively limited impact on developed world equity markets, and corporate profits generally remain healthy. Furthermore, inflation globally remains subdued, and there are few signs of overheating or excess. The biggest threat to inflation comes from the US. In particular, an acceleration of wage growth could be the trigger for the Fed to tighten policy more aggressively, presenting perhaps the biggest risk to markets in the months ahead and threatening to curtail the current cycle. One of the most important effects of the turn in the monetary cycle is that the return on risk-free assets has risen. Rates on US cash and government bonds have risen materially from the lows. In the case of cash and shorter-dated bonds, yields are back at levels last seen before the financial crisis, while 10-year bonds at 3.2% are the highest for 7 years. For the first time in a decade, most government bonds in the US are offering a real yield. This changes the relationship with riskier assets, puts pressure on their valuations, and will change the way other riskier markets perform in the months ahead. Although the global economy generally remains in good shape, this is not a time for complacency. There are good reasons to expect a period of bumpiness in markets, and greater resilience is warranted in portfolios. With policy set to tighten further, it's appropriate to keep fixed income duration short and progressively move away from credit into US Treasuries. Perversely, however, the factors which are worrying investors could provide the brake which constrains growth and inflation to sustainable levels for some time ahead. Furthermore, the strength of corporate profits over the past 18 months has outstripped share prices, leaving valuations generally at reasonable, albeit not bargain basement levels. As a result, there are attractive investments across many equity markets, and the inevitable setbacks will present opportunities to add positions selectively. Overall, we believe it remains appropriate to stay invested, building greater resilience in portfolios through more defensive assets, while at the same time taking advantage of valuation opportunities as they arise.